At AlphaBridge Advisors, we empower investors with actionable insights and cutting-edge resources. Our mission is to bridge the knowledge gap, providing expert guidance on market analysis, investment strategies, and risk management. With unbiased research and tailored support, you'll make informed decisions and optimize your portfolio. Join our community today to access exclusive reports and strategic insights that keep you ahead in the dynamic investment landscape. Selling the entire U.S. stock market is not just a tactic. It's a strategic maneuver that can protect and enhance your investments. In times of economic uncertainty, understanding how to short sell or utilize options can turn market declines into opportunities for profit. This tactic allows investors to hedge against potential losses, creating a safety net when the market spirals downwards. Imagine capitalizing on falling stock price. Seek Dip presents a new opportunity. By employing diverse strategies such as using inverse exchange-traded funds, investors can effectively shield their portfolios. Selling the market isn't merely an act of desperation. It's a calculated approach geared toward profit, even in bearish conditions. As you broaden your investment horizon, consider how effective selling can balance risk. Gaining mastery over these strategies can redefine your financial resilience and lead to a more diversified investment journey. To navigate a turbulent market, consider these three key strategies. Short selling allows you to profit from price declines by borrowing shares. Put options give you the right to sell at a set price, hedging against drops. Inverse ETFs are designed to move opposite to market trends, providing a straightforward way to capitalize on downturns. Embrace these tools for strategic market engagement. Short selling is an intriguing trading strategy, allowing investors to profit from declining stock prices. At its core, short selling involves selling securities that are not owned, with the anticipation of repurchasing them later at reduced prices. This strategy fundamentally relies on a series of well-timed actions that enable traders to capitalize on market fluctuations. The first step in short selling is borrowing shares from a broker or an investor. This initial action is crucial, as it sets the stage for the subsequent sale. Once the shares are borrowed, they are sold at the current market price, capturing immediate cash flow. The thrill of this moment lies in the market's unpredictability, as traders eagerly wait for the price to drop, hoping to execute their buyback at a lower cost. After the stock price falls to the desired level, the trader repurchases the shares and returns them to the lender. The beauty of this strategy is its simplicity. For example, borrowing and selling 100 shares of a stock at $50, only to buy them back at $40, results in a $1,000 profit. However, this strategy does not come without its risks. Investors face the looming specter of unlimited losses if prices rise, alongside potential margin calls and borrowing fees that can shrink profits. Ultimately, understanding short selling requires rigorous risk management and a keen market insight. Put options are strategic financial instruments designed to empower investors with the right to sell an underlying asset at a predetermined strike price before a specified expiration date. This unique feature offers a form of insurance against declining asset values, providing a safety net for those navigating the unpredictable waters of the market. When an investor purchases a put option, they enter a contract tied to a specific asset such as a stock or ETF. For example, if an investor buys a put option for 100 shares of XYZ stock with a strike price of $50, they secure the right to sell those shares at that price. If the stock plummets to $40, they can exercise the option, effectively selling at a premium while minimizing their losses on the asset's depreciating value. The allure of put options lies not only in their protective capabilities, but also in the flexibility they afford buyers. American options, for instance, can be exercised at any time before expiration, while European options are exercised only on the expiration date. However, investors must also tread carefully as risks include time decay, where options lose value as the expiration date approaches, and market volatility that can impact potential gains. In the end, put options serve as both a shield against losses and a potential avenue for profits during market downturns, making them a crucial weapon in an investor's arsenal. Inverse ETFs, or exchange-traded funds, are an innovative investment tool designed to capitalize on market declines by tracking the inverse performance of an underlying index, sector, or asset. These funds provide investors the opportunity to seek profit in bearish market conditions without needing to engage directly in short selling. The core concept of inverse ETFs lies in their tracking mechanism. By mirroring the movements of a specific index or sector inversely, they allow investors to hedge against risks or speculate on downturns. These funds come in various leverage options, ranging from 1x to 3x, giving traders a choice based on their risk tolerance and market outlook. For instance, purchasing an inverse SP 500 ETF would mean that if the SP 500 rises by 1%, the ETF would fall by 1%, demonstrating the fund's inverse nature. Investing in inverse ETFs offers a host of benefits. They provide unparalleled convenience, granting easy access to inverse market exposure without the need for complex strategies. Moreover, these ETFs facilitate diversification, allowing investors to manage risk through hedging or speculative plays. The flexibility to trade on major exchanges makes them an attractive option for both experienced traders and novice investors looking to navigate a volatile market landscape. However, while inverse ETFs present opportunities, they also come with notable risks. One of the significant pitfalls is the issue of compounding, as leveraged ETFs can amplify losses over time. Additionally, tracking error can lead to deviations from the underlying index's performance, particularly in volatile markets. Thus, investors must remain vigilant and consider the inherent risks associated with their investments. To successfully incorporate inverse ETFs into an investment strategy, understanding short selling and put options is beneficial. Managing risk effectively is crucial. Using hedging strategies can provide a safety net, while diversifying your portfolio can guard against potential losses. Additionally, maintaining awareness of market trends and analyses can aid in making informed investment decisions, enhancing the likelihood of success in a turbulent market.